So here are the problems. What we're going to do is we're going to value. We're going to do a bunch of valuation. And the first one on page 1 is a venture capital or private equity case study where we're the private equity firm, we're the venture capital firm. And we've identified a company that we want to buy. We know how much the seller wants to sell it for, but we have to go through the investment decision-making process, come up with a valuation for what we think the firm is valued at, and then move forward, okay, from there. So, as we know, there are 4 main valuation methods. For this case study, we are going to use earnings before interest, taxes, depreciation, and amortization. We're not using earnings because this is not an established company, it's a startup company, or mid-startup type company. So we're really looking at cash flows, okay, cash flow multiples. Because earnings wouldn't work. Earnings would probably be negative, and you can't divide by a negative. Divide something into a negative, it blows up. So we use cash flow, free cash flow. So I have to write down, next to EBITDA, write down free cash flow. Okay. Then the models we're going to use are perpetuity. We can use the perpetuity model for both the initial valuation and the terminal value that we use for the discounted cash flow. And I'm going to be talking in terminology. And if I talk too fast or you don't understand, just stop me and I'll go into detail. And then we're going to use the Gordon growth or the constant growth model. And in that, I can use the Gordon growth model for the initial valuation and also the terminal value to be used in the DCF. And then the multiple approach. There was 3 transactions that occurred within the last year on companies similar to the company that we've targeted for acquisition. And I was able to get that information from some of our investment banking and venture capitalist friends. So those are comparables. And then we're also going to use the discounted cash flow. The assumptions here is that this is a small tech startup company in the software consumer product space being bought by a private equity or a venture capital firm. The private equity firms and the venture capital firms will buy these companies, they'll restructure them, they'll manage them, they'll scale them, and then either they'll sell them to a very large company that's willing to overpay. Or what they'll do is they'll take the company initial public offering, an IPO, and then take it to the marketplace and raise a bunch of money and get paid back through the IPO. Also show the calculations for the valuations utilizing the above methods. So we have the free cash flow, which we're using EBITDA. Today, it's 20 million. Free cash flow growth rate, constant growth rates, are 15 going in and terminal is 10. Our expected rate of return is 30%, but we're going to use a 40% expected return or discount rate, calculating the terminal value. The pro forma cash flows, the cash flows are assumed to grow at 40%, 28%, 25%, and 15% per year for the next 4 years. But our holding period is 3 years. And the target acquisition price is $200 million. That's what the sellers are offering. So we're going to use the perpetuity Gordon growth multiple approach. We ask what the intrinsic value is for the target company. Using DCF, we want to know the present value, net present value. We're not going to calculate the internal rate of return or break even, but we kind of know what it is. Would we accept or reject the project? The net present value is negative. What 4 iterations? And we'll go through that. Would you go through, if you still could not get the project's net present value to be positive, what would be your last scenario be, and what would the net present value need to be? So we'll go through this iteration. The second case study is a business investment banking or a technology company acquisition. This is a more established company. We would probably be the investment banker on this one, and we would be engineering mergers and acquisitions between 2 peers. The third case study is a stock valuation. We'd be valuing a tech company, an established company such as IBM and Intel. Then on page 4, we're going to value the stock of a real estate investment trust. Now these REITs, there's one called Boston Properties, there's one called Kilroy, in San Francisco. They were the ones who did Salesforce Tower, which is like over 1 million square feet. Office buildings, probably worth over $1 billion, you know, right on Mission and First Street. This real estate, this stock valuation was really, I was thinking about Kilroy or Boston Properties when I was doing the valuation. And then an actual commercial real estate development will do the valuation of an actual development. And this development on page 5, I was really thinking about Salesforce Tower when I was putting this case study. And these are pretty simple case studies. I mean, we don't have all of the financial statements and pro formas and all the stacks of market research and stuff that need to go around this type of what is called underwriting. This is basically called underwriting. So we didn't do that. I'm just trying to train you on valuation. How do you make investment decisions? And then on page 6, we actually value a company, another REIT. But this one is actually this project. I take that back. We're not doing the REIT, even though Alexandria is the REIT that developed this project. We were hired to work with Alexandria, the REIT, to underwrite the Mission Bay project. And Mission Bay is anchored by UCSF, Genentech, you got biotech, you got biomedical, you got university labs down there. It's a multi-billion-dollar project that's been in the works for about 30 years. And then we have the investment decision-making matrix, which is here. And then the last problems are optional. They're extra credit. And then what I'll do is I'll just take the investment decision-making matrix and 2 of these other problems, and that'll be your take-home final. So once we get through this, we're pretty much, you know, most of the pain is over. Okay. There'll still be a little pain, but not as much pain. Okay. Won't be painless, but less pain, yes. Okay, so let's do this one. So if we're going to value this tech company, what are the 4 intrinsic valuation methods that we're going to use? And I'm going to be asking you just questions to test you to see if you're comprehending, if you're taking notes, and if you're picking it up. But you'll pick it up, trust me. So what are the 4, and all your information's right here. So what are the 4 intrinsic valuation methods? Multiple approach, and DCF. Excellent. And then what's the first? Perpetuity. And then what do we need to calculate the perpetuity?
Initial and terminal value.
I'm going to need what?
Initial and terminal value.
What do I need? What's the equation? What's the equation for the perpetuity? Cash flow. CFO, do we use last year, this year, or next year's? Last year, this year, or next year's? Next year's, got it. So T plus 1. And what's the cash flow we're using? What's the cash flow metric that we're using for this example? No. That's what I use to discount the cash flows. What's the cash flow metric that we're using?
EBITDA.
And we're using the EBITDA. Got it. And what's EBITDA? What's EBITDA?
Earnings before interest, tax, depreciation, and amortization.
Yeah, everything's right here. So if you read this stuff, you know, you're studying this, you pick up all the information. So earnings before interest, taxes, depreciation, amortization, which is also called free cash flow. So I'm not using earnings. I would use earnings for an established company, but since this is a newly startup, it's been around maybe a few years, I'm using cash flow because the earnings are negative. Okay, all right. So what else do we need? So I got the cash flow. What do I do with the cash flow? You can just scream it out, just yell it out. Don't be shy. When you get into the real world, everybody will be screaming and you'll be the quiet one, unless you're screaming. You you're not screaming, that number is out. And interacting, they're not gonna invite you back to the meeting. So they only want people that are gonna be totally engaging, and then where they can brainstorm solutions really quickly. So what do I do with next year's cash flow? Now, how many people have computers in front of them? Yeah. And what generation are you? Gen Z, okay, I'll take it. And what do you guys have in front of you? Computers. What can you do with computers? Look up answers. If you don't know what perpetuity is, look it up. Look it on your phone, look it up. Right? There's no reason why, other than apathy, that you would not just go get the data. Or maybe refer to your notes. Or maybe you, if you have a photographic memory, you probably remember from the pre-test, you know, and then probably we use some perpetuities on the exam. So what do I do with the next year's cash flow? It'll take forever to get through one problem, you know, if you guys just don't engage in the process. It'll take forever. Then we'll run out of time.
Divide by interest rate.
Yeah, are we using an interest rate or what else is involved?
Yield.
That's for valuing bonds. What are we valuing here? A company. Okay. So we're not using interest rates and we're not using yields. Okay. What are we using?
So present value?
That's what we're going to calculate.
Discount rate.
We're using the discount rate. What's the discount rate that we're using in this example?
40%?
What?
40%?
What is it?
40%?
Where's that?
I thought that was year bottom. Year one.
No, that's, what does it say above that?
Growth rate.
Yeah, that's the growth rate. That's not the discount rate. What are we using as the discount rate? Yeah, what is I? I'm trying to get a terminology here. So what are we using as the discount rate? What?
Equity?
Where does it say that? What do we use as the discount rate? It's all right here, it's right here. Process of, you can go through this whole list and I go, no, then I go, yes. So looking at, you know, these assumptions, and that's all these are, right? The assumptions are right here, right? So there's 1, 2, 3, 4, 6 lines of assumptions. So what are we using as the discount rate?
Is it the terminal?
15%.
What is it?
15%.
Where's that? Where'd you get the 15?
FCF growth rate, G going in.
So I got the free cash flow constant growth rate of 15%. Is a growth rate a discount rate? No. What is it?
Don't expect it to be
Is it or is it?
That's my guess.
Okay, what do you think?
Yeah.
I think yes.
Yeah, you're right. So we're going to use the expected return as the discount rate. So what's our expected return on this investment? 30%. Got it. Okay. Right. Got it. So what's the free cash flow? What are we using? EBITDA this year, last year, this year, or next year? Next year, so how do I get it? How do I get next year's? How do you get next year's cash flow?
Future value.
Yeah, I'm gonna take a future value factor, right, and apply it to what?
Present value.
No, we're calculating the present value.
So would you take the growth rate
So I would take the growth rate,
and then calculate that out?
yeah, I'd probably, you know, build a future value factor, and then what will you do with the future value factor?
Add it to the cash flow,
So we add it,
or subtract it? Yeah.
subtract it,
Wait, what?
divide it, I got all of them there now. except for the right answer.
Multiply it.
Oh, okay, there you go. Got it. So how do I get next year's free cash flow? What do I gotta do? Say it again. I'm just gonna go over it until you guys tell me to get it. What?
Multiply?
I'm gonna multiply what? What am I doing to get next year's cash flow?
This year's cash flow multiplied by the growth rate?
Bingo. So what's this year's cash flow?
20 million
20 million?
times, would you take the terminal or would you take the going in growth rate?
No, I'm gonna use the, one of the pro forma cash flows. So what pro forma cash flow growth rate would I use? Year 4, year 3?
T plus 1, year 1.
Oh, these ones.
1 point what?
1.4.
Got it. Okay, and what's 1.4 times 20? Now, everybody's got to do the calculations on their calculator. Because you can't just write the answer down, because then you won't learn how to do it. This is the physical part, dexterity, motor skills, developing your calculation. Because you're going to be in a meeting, and I'm going to be up here as the managing director, and I'm going to be going through these calculations, and you're going to be there either on your computer, your phone, your tablet, your laptop, whatever, and you're going to be cranking out these numbers. And the people who crank out the numbers fast enough get invited back to the meeting. The people who just write down the answer are not going to be invited back to the meeting. Maybe 1 or 2, because we're going to need a scribe. The other ones are going to be doing the calculations. So what's the...
28?
28
So what do we do with the 28 million? Now what do we do with that?
That's the perpetuity, right?
This is the perpetuity model, correct.
Isn't that? Oh no, I screwed up.
So now what do we do?
Go to the next year.
The cash flow
No, you got it, say it.
over, so it'd be 20 million over 20 million to fund the.
We got the 20 million times the growth rate in the first year of the cash flow. We're gonna grow the cash flows 40% in the first year because we have a team of managers that can come and completely restructure the company and optimize their supply and demand chains and their advertising campaigns. We can scale the company in the first year. Actually, that's probably too low, but that's what we can do. So what do I do with the 28 million? You were on to it. What do I do with the 28 million?
Just put it into the equation or formula for.
Yeah, so what do I do now?
Replace the I with 28 million and then put the.
Well, the I's not 28 million, the cash flow is 28 million. So now what do I do? This is the most simplest model ever.
You divide it by 30%?
You divide it by 0.3, got it. Thank you.
Why is it?
Huh? What?
Why?
just sharing.
Because that's the expected return.
Oh, the expected. Okay.
That's our discount rate, that's what we said earlier. We were gonna use the expected return. So we require at least a 30% annualized rate of return on this investment. Okay? So what's 28 million divided by 0.3? 93.3. I don't need a bunch of decimal points. Okay? So just round up to 1 decimal point. Although some people would love 4 decimal points. I don't think we need them. So what's the next method? Yep. Or it's also called the constant graph. And what's the equation? So hold on, cash flow, last year, this year, or next year? Next year, got it. And then what do we do with that? Divided by,
So interest minus G.
how do I I is what? It's not an interest rate. Perpetuity cash flow.
Expected rate of return.
Yeah, the I is the expected rate of return. And what's the G? Growth rate in what? Yeah, and the cash flow. So what's the assumption here about the cash flows? Do they remain flat forever, or do they grow at a constant rate? Are they flat into perpetuity, or grow at a constant rate into perpetuity? Constant, yep, it's flat. And then what about this one? What do you assume the cash flows are gonna do?
Increase.
Increase at a constant rate, got it, okay? And that's gonna give us the valuation using Gordon graph, awesome. And what's next year's cash flow? What is it? What's next year's cash flow? What's this year's cash flow?
20 million.
Got it, what's next year's cash flow?
28.
Got it, are we gonna use this year's or next year's?
Next year's.
Got it. Now what do we do? Point three minus 0.15, the going in, what do we get? What do we get? Okay, let's just do subtraction in our head. Okay. 0.3 minus 0.15 equals 0.15. Got it. All right. I know it's late, it's a night class and all that stuff. Okay, so what's 28 million divided by 0.15?
186 million, 0.6.
186 million, 0.6.
7.
Is that right? You got it? Okay, one more. Okay, we need at least 3 confirmations. Do you think people make mistakes?
Yes.
All the time. All the time, like. And what happens if we're in a meeting and everybody's making the same mistake? Because you got too much stake. And you guys lose the company $20 million because nobody was, had enough guts to say anything about it. You'd all be fired. All right, what's the next model? Yep. Multiple approach, got it. All right. And what's the equation? What's the equation? Okay, what cash flow, this year, last year, and next year's? Next year's. Times what? Oh, shit, I should have said it. What are we multiplying the cash flow by? What are we multiplying next year's cash flow by?
Growth rate.
Are we multiplying it by a growth rate? Like that? Come on, Cortland, don't, you're gonna be up there in front of, trial jury someday, and, you're gonna be saving my butt from, so what do we do? By the multiple, and I'm using, this year, last year, and next year's multiple. Next year's, and what's that gonna give me? What's that gonna give me? It's gonna be the value, using the multiple. And is this value gonna be the value of the firm last year, this year, or next year? Next year, got it. And in all of these cases, aren't we calculating the values for next year? What we think the future value of the company is gonna be? Yeah. Got it. All right, so what's next year's cash flow? 3 billion. Got it. Oh, let me tell you what the multiple is. The multiple is the it's going to be the company's sales price. Now, this isn't this company's sales price. There's 3 companies that sold similar to the target company that we were looking to acquire within the last 6 to 12 months. We called up, some of our friends that work at these private equity firms and investment banks and asked them, we said, hey, there was a few companies that just sold just like the one we're looking at, although you didn't hear that. What were the cash flow multiples in which they sold that? So you're gonna take the company's sales price, and you're gonna divide it by the EBITDA. So these are cash flow multiples. The sales price of the company divided by the annual EBITDA. It's gonna give us the annual multiple, the multiples. And do they give us any multiples in this case study?
22, 44, and 55.
Yeah. So they gave us a few of them, right? 55 times, what was the other? 44 times, and 22 times. Got it. We got 28 million. You see where I'm going here? You guys should already be starting your calculations. So what's 55 times 28 million? It's so quiet in here. What's,
1,540.
what is it?
1,540.
1,540 like that? So 1,540 million or 1.5 billion?
Yeah.
Is that a lot of money? What's 28 million times 44 times? 44 times 28 million.
1,232.
1232. Is everybody getting that?
Yeah.
Yeah, it's billions. So 1.2 billion.
And then what's 22 times 28? 616 mil or 0.62 million. Got it. Let's do a little analysis here. Where are we in the business cycle right now? Where are we in the capital market cycle right now? Okay, let's try this again. When was the last recession? Okay, 2008, 2009. Excellent. Where are we now? Okay, but where are we? 2019, right? So 10 years. So are we in the recovery phase, the business cycle? Are we in the peak mature phase? So what do you think about cash flow growth rates or cash flow multiples so late in the cycle? Do you think they're going to be at the top? The multiples are going to be at the top? We're not in a recession or going into a recession just yet. So this is probably worst case scenario. This is the best case scenario. Would you be using best case, worst case, or midpoint? You'd be using a midpoint. It just makes sense. Because it's not the frothy. I mean, WeWorks, they're gone, right? Maybe. They didn't go public. A bunch of other tech companies have lined up to go public and fell flat or decided they're not going to do it. So it's not the peak of the market anymore. But it's not the worst of the market. So I'd pick something in between. So that's probably the best case scenario right now. Got it. Here's another little, I didn't do this in the last class, but a little note for you, which I think is kind of interesting. I can also create multiples. by taking 1 divided by the discount rate. So what's the discount rate that we're using?
Was it a 0.4 or?
What are we using for the discount rate?
Expected rate of return,
30.
30%.
Got it. So can you calculate that multiple for me? So 1 divided by 0.3,
3.33.
is that it? Yeah. Is that a good multiple? Is that a good multiple?
Doesn't look good
No.
compared to the others.
Yeah. Well, what is it? It doesn't take into consideration any growth rate. So let's do the one with the growth rate. So we do 1 divided by I minus G. And what was that? Yeah, it was 1 divided by 0.15. And what's 1 divided by 0.15? What is it? 1 divided by 0.15. 6.66, got it. So what's 3.33 times 28 million? What's 3.33 times 28 million? The same thing. And what is 6.66 times 28 million?
186.48.
Got it. So basically, I can use these models, I can convert them to multiples, take the multiples, apply them to the cash flows, and get exactly the same numbers. Okay. But the investment bankers and the private equity people don't think in these terms, they think in multiple terms. Okay. They're always thinking in cash flow multiples. It's just a different philosophy. It's the way they think. Okay. What's the next method? Yeah, discounted cash flow, DC. Excellent, okay. So what are we trying to calculate when we calculate the DCF? What are we calculating?
Terminal value.
Huh?
Terminal value?
Not the terminal value, we're gonna do that over here.
Oh.
What is
It's
it?
on the bottom there.
Present value, awesome. Got it, PV, excellent. Now what do we need to know? To set up the discounted cash flow equation, what do we need to know? What do we need to know to do a DCF?
Cash flow?
How many? How many? What's the DCF? What are you trying to calculate? What's the structure of the equation? Huh? 3 years. Is that the holding period?
Yeah.
Got it. So you need to know the holding period first. Don't worry, you know, by the time we get through a bunch of these, you guys will be yelling stuff out like that. It's not gonna be a big deal. So this is year 1. This is year 2. This is year 3. Got it. Is that all we need? Just 3 years? That's it? So I can do everything from here? Is that it? What do your assumptions say? Yeah, assumptions say no, right? So what do we have to do? What do we do? What do the assumptions say? What does it tell you? It's all right there.
Add another year.
What?
Add another year.
Gotta add another year. Why do we add another year? Why do we need to calculate the 4th year of cash flow? trying to calculate from the cash flow? What do we need? Close, there's another word for it. Terminal value. Got it. It's funny, if you read this, it's actually all the data is right there in 6 lines. Okay, so we're gonna calculate the terminal value. Got it. Got it, terminal value, woo-hoo. All right. Party. All right, so what do you want to do first, the discount rates or discount factors or the cash flows? You have to decide.
Cash flows?
Okay, what's the first year's cash flow?
Wait, nope.
What is it? What's the first year's cash flow?
28.
28, got it. All right. And how do I get year 2?
Do the same way we calculate it.
What am I doing? Just describe it. How do I get year 2? How do we got year 1? If you remember how to do year 1, we could probably figure out year 2. So how do you do year 2?
Divided by 1.4.
No, year 2 is 1.28.
Okay, so what do we multiply the first year cash flow by? 1.3.
1.4.
No, you guys are guessing.
1.28.
You got it, 1.28, because that's the pro forma cash flow. This is what we're projecting as the pro forma cash flows. We already gave you the growth rate. So what's the equation right there? How do you create a future,
sorry.
future value factor to grow it out? What is it?
Wait, would we times the 1.28 times the 28 million, or would we?
Exactly.
Oh, okay.
Right.
Because this keeps growing.
1.28, perfect. Okay, what's 28 million times 1.28? Come on, get your calculator out, start calculating.
3.58.
I got a billion, 40,000 trillion. Okay, what's that up?
28 million times 1.28 gives me $3,580,000. Is that right? Is that right?
What?
28 million times 1.28, 30.
No, that's
35.
35.8
million.
Thank you.
I was like, what?
And people go, yeah, that's what it is. No, it's not. Okay, so how do I get the third year?
Divided by 1.25.
What is it, 1.25?
44 million
So
700.
what's 35.8 times 1.25?
44 million 750,000.
So 44 million,
750.
75,
Yep.
got it. Now what do we do?
Times it by 1.15.
That's 1.15, got it. What do you get?
$51.46. And some change.
All right, excellent. Now what do we do with that?
Huh.
Add it all up and it gives me the present value.
And you add up the fourth year you add as well, right?
What do I do?
You add the fourth year on too as well? There's just no, do we add the 4 years too? We had all the years.
What's the model called? Discounting cash flow. So what do we need to do? Discount the cash flows. Got it. Okay. So what do we do with this number? Why do we have the fourth year? What do we do with the fourth year's cash flow?
Divide, subtract it.
Okay, divide it, subtract it.
I don't even know anymore.
Why do we grow it out one more year? What are we trying to get? Terminal value, exactly. Oh, shit, I already wrote it up there. All right, so how do I get the terminal value? First things first, what do I use? What kind of model do I use? Do I assume that the cash flow is going to remain flat forever or grow at a constant rate? Grow at a constant rate. Because what kind of company is this? It's a growing company. So what do we divide it by? to you here? Does it tell you? Probably, within those 6 lines. You're in the terminal, so you're probably gonna use the terminal, exactly, you're gonna use the terminal discount rate of 0.4 minus what? Say it.
0.1,
0.1. Bam, what do you get?
0.3.
Got it. And what's 5146 divided by 0.3?
$171,000,000,
171.
533.
53 million. Got it. Okay, what do we do with that? What do we do with the terminal value? Do I divide that by 1 point, whatever the discount rate is? What am I doing with this? Maybe we should go do the discount factors for a little bit so you guys can do them. So what would be the discount factor for the first year?
Oh, there's a whole other section.
Oh, yeah.
Whoops.
Well, no, you guys want to do the cash flows first. You just got done with all the cash flows. Now what do we do? What's the model called? Discounted cash flow. So what are we trying to determine?
The discounted cash flow.
Factors. The discount factors. That will give us the discount. If we discount it, we'll get the discounted cash flow. What's the first factor?
1
1.
plus the
Got it.
discount rate,
What?
plus the discount
Yeah,
rate.
which is,
Or,
what was it? What were we using as the discount rate?
0.3.
Got it. Okay. And to the 1. So what's 1, right? 0.3 to the 1. 1.3. Got it. Okay. Sorry, I'm trying to make it as hard as possible. So what's the second discount factor? 1.3
To the second.
squared. Got it. It's 1.3 cubed. Squared. 1.7. Got it. It's 1.3 cubed.
2.2.
What's it? 2.2. Got it. And now we're cranking. Okay, test question. What do I do with that terminal value? I don't know what to do with the terminal value. What do I do with the terminal value? What are we gonna do with the terminal value?
Subtract it from the present value?
Why would I do that?
Never mind.
just divide it by the 1.3 with the.
Got it. I got the terminal value here. What do I do with that number? Add it to
Oh, the present value.
what?
The other 3?
Say it, somebody said.
Present value. No?
The other 3 years,
Do I split it over it or just add it to the last year?
add it to the last year.
Perfect. That's exactly what we're gonna do. Okay, so it's 171.53 plus 44.75.
$216.28.
216.23, right? 216.3 right? Is that right? Okay, cool. Okay, now what do I do with that? What's the model called? Divided by 2.2. Excellent. And what's 216.3 divided by 2.2? $216.3 divided by 2.2.
98.32.
98.32, got it. So does everybody get it? So you take the, this year's cash flow, you grow it out to get the first year's cash flow. And you grow out the cash flows. It's a 3-year holding period, but you gotta grow it out one more year. Then you divide it by the terminal discount rate minus the terminal growth rate to get the terminal value. Take the terminal value, add it to the last year's cash flow in the holding period, gives you the total cash flow you're gonna get in the last year of the holding period. Divide that by the discount factor, you're gonna get the discounted cash flow for the last year in the holding period. Okay, and then what do we do next? What's the next thing we do?
Figure out the.
You add 173 percent of value to, 1.8, year 2?
This one?
Yeah.
So you're gonna divide 35.8 divided by 1.7. 35.8 divided by 1.7, what do you get?
21.05.
What is it?
21.05.
So 21.1?
Yeah.
Yeah,
No.
21.1, got it. And then what do we do?
Divide 28 million divided by 1.3.
Got it. And what's 28 million divided by 1.3? What is it?
21.5.
Like that? Okay, what do we do now?
Add them all up.
Add them all up, what do you get?
141.
Got it. All right. So you grow them all out, we grow it out by one more year past the holding period. Apply the Gordon growth, because in most cases, these real estate assets and companies are gonna have constant growing cash flows forever. You get the terminal value, of the terminal value to the cash flow in the last year of the holding period to get the total cash flow that you're going to discount by the discount factor to get the discounted cash flow. Do it for each of the other years, sum it all up, you get present value using the DCF of 141 million. Got it. Here's the other thing. You see the going in discount rate? You see the terminal discount rate? Why would the terminal discount rate be higher than the going in discount rate? Why would you use a higher discount factor? Okay, what kind of company is this? Yeah, but what kind of company? It's a tech company. So are tech companies subjected to, fierce competition? Absolutely. And do you think that's gonna add additional risk to this investment? Absolutely. So don't you think we should take up the discount rate to reflect the additional risk in the future? Because I can't forecast what's gonna happen in the future 4 years on. I just know it's not gonna be easy to forecast. So I want to discount at a higher discount rate to reflect that risk, which will bring back down the terminal value. And then what about the constant growth rates? I was using 15% on the Gordon growth. I've lowered it to 10%, and I was using 28, 25, and 15 over here during the pro forma period. Why would I be using a slower growth rate?
More risk, you're not actually gonna hit that growth rate.
And do you think there's gonna be severe competition? Can we forecast exactly what the competing technologies or firms are gonna be in 5 years from now? No. So I need to adjust the growth rates down, and I gotta increase the terminal discount rates to reflect the discount, the risk. Now here's the problem in the book. The book doesn't even talk about this. Because the book just says, okay, we'll just use the same discount rate and use the same growth rate over there for here. Well, that's not reality. In the real world, we're gonna increase the discount rate and lower the growth rate to better reflect the risk of the investment. But if we're using if we're using a discount rate of 30%, and I use it over here, what's gonna happen to the terminal value? If I'm not using, if I use 0.3 here instead of a 0.4, what happens to the terminal value? It goes, if I use 0.3 here instead of 0.4, the terminal value goes up. Got it. Okay, goes up. That's my point. If I'm using the 15% growth rate here as opposed to the 10, what happens to the terminal value if I'm using 15% as opposed to 10? What happens to the terminal value? It goes up. So basically, if I'm using the same going in discount rates and I'm using the same growth rates, going in growth rates, am I overvaluing or undervaluing this asset? Am I gonna, is the present value gonna be higher or lower if I'm using a lower discount rate and a higher growth rate?
You're undervaluing it.
Is the present value gonna be higher or lower?
Higher.
It's gonna be higher. Okay, so it'll be higher. Okay. But I'm not taking into consideration, so I could actually be accepting a project because of the inflated terminal value. Okay. Now this is what they do. When I was at the real estate firm, the acquisitions analyst would always assume that the board members of the investment committee didn't have enough time to look at the terminal value calculations, because what they would do is they would inflate the terminal values to inflate the present values so that the board would look at the project and it would be overvalued and they'd accept it. And then they would find out 5-6 years down the road that the acquisition analyst totally juiced the underwriting so he could get his bonus check, based on this acquisition. So it was completely and totally unethical, what they did. But he financially engineered the solution so that the board would think that the property was worth more than it actually was, and they would accept the project. And then find out later on that the underwriting was flawed. And by that time, the acquisition analyst was off to another job. Okay? So that's part of the principal agent problem there. Okay? So let's go over here. Well, let's look at this for a minute. What are the valuations using perpetuity? What's the valuation using perpetuity? Got it. What's the valuation using Gordon Growth? What's the valuation using multiple? What's the valuation using DCF? What's wrong? What's going on? If you were to use one valuation method, which one do you think is the most accurate in this case? Which one is the most accurate methodology to calculate an intrinsic value for this use case? For this use case? Which one?
DCF.
Okay, I got one DCF. Anybody else? DCF? DCF?
Got cash flow.
DCF? Anybody else? Okay. In this scenario, in this use case, the method that we would use is multiple approach. Because these are the actual transactions that occurred in the marketplace over the last 12 months. It's really fun to do perpetuity and Gordon Growth and DCF in this use case, but it's totally irrelevant. There are analysts that I talk to, they don't even use DCF. They don't even use perpetuity and Gordon Growth. They use the multiple approach. Because they're looking at calculating valuations based on what they can. If I can buy this firm for $200 million and it's worth $1.23 billion, would I buy it? Absolutely. And what kind of company is this? Yeah, it's tech, software, consumer products. I mean, we can get in there, we can take over the firm within 3 years. We can probably grow these cash flows a lot faster, right? So part of our problem was cash flows were totally underestimated. Maybe the expected returns were a little bit too high. But I think it was the cash flow and growth rates. And we probably made a mistake on the initial cash flow over there of 20 million too.
What was the reasoning for the multiple approach again?
Because those were the actual transactions that occurred over the last year. Companies were selling at 55, 45, and 22 times their free cash flow. Those were actual deals where people were willing to pay that much for the company. So we look at this company and it's like, oh, 200 million? Shoot, we can go in, restructure this company and sell it in 4 years for 1.2 billion. Right? Those are called unicorns. Yeah, that's what they're actually called. They're called unicorns because we have a bunch of them here in the Bay Area, where people are willing to pay, multiples upon multiples for these companies that don't even have, earnings yet. And then they move and start to scale very rapidly, and then some point in time, they're gonna monetize the cash flows. I mean, what's Uber worth? What's Lyft worth? What's Salesforce worth? Those are all companies that emerged over the last 10 years. All right, so let's do some analysis here. So what was the present, which methodology do you want to use? Multiple approach, got it. So using the multiple approach, what's the intrinsic value? What's the intrinsic value?
1.23 billion.
1, 2, 3, is that what you said?
Yeah.
Million. I'm gonna convert it back to millions because it'll be easier. And then what was the acquisition cost or price?
200 million?
200. Got it. And what is my net? What's my net present value? What's my NPV? It's pretty easy, isn't it? 1230 minus 200. 12 minus 2 gives you what? What is it? 1,030 million. Is it positive or negative? Positive. Do we accept or reject it? Got it. Now that was pretty easy. That was shooting ducks, basically. Okay. What happens if the acquisition price is 1.2 billion? Then what's my net present value? 30. Okay. Actually, I want to do this a different way. Let's do this. So the intrinsic value is $1 billion, but the acquisition price in which they're selling it, is 1.25 billion. So what's my net present value?
Negative,
What?
Negative 250.
Got it. Negative 250. Under that scenario, would we accept or reject it?
yeah.
Got it. But what if we want it? Do we want this company? We don't? It took us 6 months to underwrite it. Took us another 6 months to find the company. It's got some IP in it that's pretty valuable. They're actually scaling pretty rapidly in regards to the product adoption. We've lined up some pretty big clients in the process. It looks like we would be able to take them global through our global distribution channels. Do we want this company?
Yeah.
Yeah, so the question is, what do we do? How do we make this thing work? How much time do I have? This is the answer to number 7. I mean, page 7. company really wants this. The board of directors really want this. The investment committee really wants this company. But it's really hard to justify because we have a negative net present value, which in all other cases we would reject this project. But the company really wants it. So what we're gonna do is we're gonna go through some iterations. Because we need to figure out, is this a project that we really want to do? Do companies do this? Yeah, they do. I know you guys didn't, read forward, but this is the capital budgeting chapter in application. You should be writing this out. And then what we're going to do is we're going to play a little game. We're going to do a little sing-along. You guys like sing-alongs? I love sing-alongs. The Sound of Music, Castro, it's awesome. With Julie Andrews. This is actually Larry's music sing-along. It's called My Finance Sing-Along. Okay, here we go. Okay, so this is your investment decision making right here. Okay, we're going to do a little sing-along. All right. So I'm going to ask the questions, and you guys are going to sing along. Okay, just like we're singing along with the Castro to the Sound of Music. Okay, are you ready? This is Larry's finance sing-along. All right. So when the present value is greater than the price or the cost, do you accept or reject the project? Okay, that was totally weak. Okay, let's try it one more time. So when the present value is greater than the price of the cost, do you accept or reject the project?
Accept.
Got it, somebody said reject, but that's okay, it was your first time. And then when the present value equals 0, do you accept or reject? Oh, sorry, this should be this. Sorry. It's getting late. When the present value is equal to the price of the cost, do you accept or reject? Accept. Okay. When the present value is less than the cost of the price, do you accept or reject?
Reject.
When the net present value is positive, do you accept or reject?
Accept.
Got it. When the net present value is 0, do you accept or reject?
Accept.
Accept.
Now everybody's singing. When the net present value is negative, do you accept or reject?
Reject.
Accept.
When the internal rate of return, when your rate of return is higher than your weighted average cost of capital, do you accept or reject?
Accept.
When the internal rate of return is equal to the weighted average cost of capital, do you accept or reject?
Accept.
When the internal rate of return is less than the weighted average cost of capital, do you accept or reject?
Reject.
When your break even is less than 3 years, if I can break even on this thing in less than 3 years, do I accept or reject?
Accept.
When the break even is 3 years, do I accept or reject?
Accept.
Got it. And when the break even is greater than 3 years, do you accept or reject?
Reject.
So do you get it? It's a decision rule. If you know one, then you know the other 3. So that's what's going through our minds here.
Is that for every year or just the first year? That idea, is that for
No,
every
this
year?
is the present value. This is all using discounted cash flow methodology. So if the break even is greater than 3 years, then my internal rate of return is less than my weighted average cost of capital. My net present value is negative, and my present value is less than the price or the cost. So if you know one, you know the other three. So you could be in a meeting and they're talking about break even, and IRR, and, you know, MPV, and PV, and, you know, you're following along, you know, you're getting it. And then if you know that the present value is greater than the price of the cost, then you know that the net present value is gonna be positive, the internal rate of return is greater than the WACC, and your break even is less than 3 years. And if the present value is equal to the price of the cost, then you know that the present value is equal to 0, the IRR equals the WACC, and the break even equals 3 years, which means that you're gonna accept. So if you know one, then you have the others. So let's go through this. Let's go through the iterations. So what happened was we underwrote this deal and we got a negative net present value of $250 million. But the board of directors said we really want this project. Can you go do something? What can you do right now? Can you go right now to go do something to make this thing work? So what could you do to make the project work? Could I go back to the seller and ask for a price reduction in the amount of the negative net present value? And if I do, what happens to the net present value? Turns to 0, and I end up doing what? Accepting it. Got it. So I can do this. Do this. And this. And this. So if I can get a price reduction in the amount of the negative net present value, my net present value will turn to 0 and we'll accept the project. Now, what do you think the seller is going to do? Are sellers always happy to give you a price reduction in exactly the amount that you need to get the MPV positive or 0? Probably not. Probably not. But the first thing you're going to do is you're going to ask for a price reduction. In the amount of the negative net present value. That's what you're going to ask for. Got it. Well, what if the seller doesn't give it to you, the price reduction, in the amount of the negative net present value? You got to go to iteration 3. Iteration 3 is basically you got to go back and you got to go back and review all of your assumptions. In your investment underwriting. So start reading off the assumptions that we would have to go back and review. Isn't those 6 lines under the assumptions on that page? No, I'm not trying to, what is it? What assumptions would we go back and look at? You can just read down from the assumptions list. Can somebody read down the assumptions list for me, please?
Is it small tech startup?
No, the assumptions list. Okay, what are those over here? We already went through everything.
Earnings per share. Free cash flow?
Yeah, in what year? What's it called? EBITDA. Got it? Okay, give me the cash flows. What are all the assumptions around the cash flows?
28 million.
Okay, what did we have before that?
20 million.
20 million, so the initial cash flow? If we underestimated the initial cash flow, wouldn't the net present value be negative? And if we could increase the initial cash flow, wouldn't the net present value shrink? Because the present value would go up. Maybe we underestimated the initial cash flow. What other cash flows?
Discounted.
Discount rate. over or underestimate the discount rate? Overestimate it, because if we lower it, the present value is going to do what? Come on, it's all logic. If the discount rate goes down, the present value goes up. Got it. So did we over or underestimate the discount rate? Did we over or underestimate it? Overestimated it, okay? So we have to look at the discount rate. How many discount rates do we have? No? Now we count discount rates. What are we using for the discount rate in this example?
30%.
Yeah, well, what are we using? What's it called? What?
Expected rate of return,
That's correct. And what are we using?
30%.
Yeah, but it's also called what? So it's right there. So all you gotta do is read it. Expected return
Terminal.
and the terminal. So it's going in. Going in. Terminal. Expected returns. So we overestimated the discount rate. Do we over or underestimate the initial cash flow? Did we over or underestimate the initial cash flow? Underestimated it, got it. What else? What are some of the other assumptions? They're right there.
Pro forma cash flow growth.
Got it. Got it. Pro forma. Cash flow. Growth rates. Got it. Do we under or overestimate the growth rates? Underestimated the growth rates. Got it. Okay. So that's pretty much all of it. That's what I was looking for. So, but I got bad news. You went back and you spent like a couple more weeks, a few more weeks. You basically reviewed all of your assumptions that went into your underwriting model, and you still get a negative net present value of $250 million. In this case, you would reject it. But when you went back to the board, and the board says, no, we really want this company. We need to do one more thing. We need to calculate the value of a real call option. We're going to calculate the value of the real call option. Because these tech firms, we understand these tech firms. This is our acquisition price, in which we can buy it. But we're going to have to pay some premium. And the premium is going to be the negative net present value amount. And we know that these tech companies, their valuations are highly volatile, but right, they could go straight up, right? Because these companies could scale pretty quickly and then they become unicorns in the valuations. Go through the frickin' roof. So we know that the main reason, the main contributor to the valuation of the call option is going to be valuation. It's going to be valuation volatility. The more volatility in the valuations, we could be in the money pretty easily in the future. So they're anticipating that. The other is management decisions. The management team is critical in the ability to execute on these acquisitions and then turn these companies around and scale them and turn them into multi-billion-dollar corporations. That's the other. And the other is time. The other is time value. And usually these acquisitions, they take some time. And the gestation of valuation, the value of these really companies really come into play. It could take years before we reach billions of dollars in market cap. So the time period here. These real call options have a lot of time value in them. Managers can create value through their management decisions. And the volatility of these types of companies in itself also contributes to the value of the real call option. So the question is, what is the value of the real call option need to be for us to get a net So what does the value of the real call option need to be to get a net present value that's equal to 0 or positive? So what does the value of the real call option need to be?
Yeah, so,
Go ahead. You've got it. What does the value of the real call option need to be?
yeah, so,
And what's the under these scenarios right now, what's the net present value? What's the net present value? Negative $250 million. So you can accept or reject it. Reject it.
Reject.
But if I get a value of a real call option, I calculate the value of the real call option, what does the value of the real call option need to be to get a net present value that's equal to 0 or positive? What is it? Got it. 250 million. Which is the amount of the negative NPV. Got it. So if I calculate the value of the real call option, and it's greater than the negative net present value, then my net present value is what? If the value of the real call option is greater than the negative net present value of $250 million, then my net present value is what?
Positive.
Positive. And when it's positive, what do? You accept it. Got it. And what if the value of the real call option is exactly equal to the negative 250 million net present value? Then what's your net present value? 0. Do you accept or reject it? Accept it. Got it. And if the value of the real call option is less than the negative net present value of $250 million, then your net present value is what? Negative. And you're going to do what? Got it. Whew, I'm exhausted. Okay, that's it. That's investment decision making, capital budgeting. But the book doesn't teach you the 4 iterations. We just basically